China's real estate market is causing quite a stir, not just within its borders, but around the globe. As the world's second-largest economy, China has long been a reliable engine of growth. However, the bankruptcy of Evergrande Group in August 2023 was a wake-up call. It's like seeing a giant topple. Unpaid bills from private Chinese developers have skyrocketed to an eye-watering $390 billion, according to Gavekal Research. This staggering debt has economists downgrading their growth forecast for China, with many predicting it will fall below the government's target of around 5%. The central question now revolves around how to remedy the situation. But before we think about solutions, let's rewind a bit. How did we get here? Are we potentially looking at a broader market implosion? China's real estate crisis didn't happen overnight. It was building up for decades. For many years, China's economy was a powerhouse, in large part due to a booming real estate sector. Starting in the late 1990s, the country witnessed a real estate explosion. Cities expanded rapidly as people moved from rural areas to urban centers in search of better opportunities. This massive urbanization drove the demand for housing, and developers responded by building at an unprecedented pace. Real estate has now become the backbone of China's economy, contributing about 30% to the national GDP. Imagine that, 1/3 of the economic output tied to buildings and apartments. But it wasn't just about numbers. In China, owning property is deeply rooted in the culture. Why? Well, historically, land ownership was a sign of wealth and status in the feudal society of old China. As the country modernized, owning property in booming cities like Shanghai and Beijing wasn't just about having a place to live. It was about securing your slice of the economic pie and showing off your success. As cities expanded and the middle class swelled, the demand for housing skyrocketed. This created a cycle. More demand meant developers could sell apartments faster, and faster sales meant more money to build even more apartments. It seemed like a win-win until it wasn't. By the late 1990s and early 2000s, the market was red hot. Developers began to overbuild, taking on massive amounts of debt to fund projects in anticipation of future demand. They borrowed heavily to pay for these projects, betting that the demand for housing would keep soaring. This led to a situation where about 1/5 of all homes in China were empty, essentially ghost cities waiting for occupants who never came. For instance, back in 2021, if you took a drive an hour or two outside Shanghai or Beijing, you'd notice something quite striking. The cities there stand tall, modern, and generally well-maintained. However, unlike their bustling Tier 1 counterparts, they're strangely quiet and sparsely populated. These are what are often referred to as China's ghost cities. Their existence has captured widespread attention. One notable example was highlighted in a 2013 segment of CBS's 60 Minutes, where correspondent Leslie Stahl found herself on a major road during rush hour with hardly a car in sight. Perhaps the most famous among these ghost cities is Ordos New Town, also known as Kangbashi, situated in Inner Mongolia. Originally planned in the early 2000s to accommodate up to 1 million residents, this ambitious target was later revised down to 300,000. Yet by 2016, only around 100,000 people had actually moved in. Recognizing the overheating market, the Chinese government stepped in. In late 2020, they introduced debt ratios for property developers to curb excessive borrowing. In other words, they introduced rules to limit how much debt developers could take on. The goal was to prevent the market from overheating further and to encourage more sustainable growth, but the policy had unintended consequences. By 2021, the measures began to bite, and one of the giant players in the market, Evergrande Group, started to falter under the weight of its debts. The collapse of Evergrande, once the world's most valuable real estate company, was the first domino to fall in China's real estate crisis. Evergrande started out in 1996, targeting the upper middle class, but its excessive borrowing and overbuilding habits led to its downfall. By 2021, it had defaulted on over $300 billion in debt, with assets nowhere near enough to cover the liabilities. When a court ordered its liquidation in January 2024, the true depth of the crisis became painfully clear. Country Garden, China's largest property developer, faced a similar fate. With a jaw-dropping debt of $205 billion, the company hit a severe liquidity crunch. Now it's undergoing a liquidation analysis after a petition was filed against it. When a giant like Evergrande stumbles, it sends shockwaves through the entire industry. Other developers faced similar troubles, and soon they too were struggling to pay back the money they owed. According to global data TS Lombard, since the beginning of 2020, at least 60 Chinese property issuers with over $140 billion in collective outstanding dollar bonds have defaulted. This staggering figure calls attention to the severity of the crisis. Now, the pressing question is, how did it all come to this? Pessimism among potential homebuyers. First and foremost, potential homebuyers in China are growing increasingly pessimistic about their job security and future earnings. A recent survey by CBRE indicated a sharp decline in the intent to purchase homes in 2024. This shift in sentiment is crucial because for decades, real estate has been a stable investment and a marker of social status in China. When people lose confidence in their economic future, they're less likely to commit to large financial obligations like buying a home. With fewer buyers, the surplus of unsold homes increases, intensifying the issue of ghost cities and empty properties. Also, reduced demand typically leads to a decrease in property values, affecting homeowners' equity and developers' profitability. The second major factor is the instability plaguing real estate developers. Many of these companies are defaulting on project deliveries, which has significantly reduced consumer trust. Imagine putting your hard-earned money into a property only to find out that the developer can't finish the project. This scenario has become increasingly common, making potential buyers skeptical about investing in new properties. Next up is demographic shifts. China's demographic challenges are adding fuel to the fire of the country's property market meltdown. An aging population means fewer young people are entering the housing market. With fewer new households being formed, the demand for additional housing drops. Think about it. Fewer young buyers mean developers are left with a surplus of unsold properties. This isn't just a temporary dip, it's a structural change that suggests a prolonged period of weak demand, making it tough for the market to bounce back quickly. Another critical factor affecting China's housing market is the issue of excess supply, which has notable implications for both investors and residents alike. The central bank's data reveals that 96% of urban households in China own homes. Among these, 31% own 2 properties, while 10.5% own 3 or more. This high rate suggests that, essentially, many properties in major cities aren't being used as homes, but rather kept vacant purely for investment purposes. This speculative demand drove up prices in previous years. Now, as investors start to pull back, there's a surplus of properties flooding the market. This situation makes it increasingly unaffordable for regular people who actually need homes to live in. After more than 2 decades of soaring property prices, the market is hitting a saturation point. Those who can afford homes already own multiple properties, while those who can't are finding it harder than ever to break into the market due to soaring prices. Looking at it from the perspective of real estate developers sheds more light on the issue. Take Evergrande Group, for instance. By the end of 2021, Evergrande had a total of 1,322 unfinished projects covering 300,000 square meters. This backlog of unfinished projects has further distorted the market, leading to inflated prices and a credit crunch for developers. Now, let's talk about one of the biggest game changers for real estate: COVID-19. The COVID-19 pandemic has had a deep impact on consumption patterns and investor confidence. During the initial lockdowns, many people tightened their belts and focused on saving rather than spending. This shift towards saving over spending means that fewer people are willing to invest in real estate, preferring to keep their money liquid and safe. Recently, the People's Bank of China reported a massive increase in deposits. We're talking about 18.82 trillion yuan, which is about $2.6 trillion, in just the first half of 2022. That's a hefty 1/3 more than the previous year. Households alone pumped in 10.33 trillion yuan, which is a 38.7% increase compared to 2021. But why the sudden surge in savings? Well, with all the uncertainty in global markets, people are playing it safe and stashing away cash instead of diving into risky investments like buying property. On the flip side, the job market hasn't been so rosy. According to the National Bureau of Statistics, the urban unemployment rate in China's top 31 major cities has been climbing steadily, going from 5% back in late 2019 to 6% by May 2022. What industries were most affected? Restaurants, tourism, and hospitality. Basically anything that relies on people going out and spending money. With so many people out of work or uncertain about their jobs, saving up for a down payment on a house is becoming a real challenge. And it's not just individuals feeling the pinch. The accommodation sector, hotels, B&Bs, you name it, has also been taking a beating. Research shows that star-rated hotels alone lost billions of yuan each year in 2020 and 2021. Those kinds of losses are forcing struggling businesses to call it quits, which in turn means less demand for real estate. So what's the government doing about it? They've unleashed measures to jumpstart the housing market. They've made it easier for first-time buyers by lowering down payments and cutting mortgage rates. They've even relaxed the rules on who qualifies as a first-time buyer, making it a bit less daunting to get into the market. It's all aimed at easing the financial squeeze. But here's the thing. Despite these efforts, the Chinese government's credit support of 469 billion yuan, which is about $65 billion by the end of March 2024, isn't nearly enough to tackle the scale of the crisis. The government also outlined some programs aimed at boosting spending and investment. Here's how it breaks down. Local governments are stepping in to buy up those apartments that have been sitting unsold because nobody's been buying them. They're planning to turn these places into affordable housing as part of new trial programs that are now being adopted nationwide. In the latest move, the central bank is putting together a whopping 300 billion yuan, which is about $42 billion, to help state-run companies and local governments purchase these empty homes for the affordable housing push. Vice Premier He Lifeng made it clear that each city will get tailored policies to tackle the challenge of dealing with all these unfinished properties. Sure, there were some hopeful signs at first, but the long-term outlook is still pretty bleak as it is. Before we dive into the last part of the video, make sure to check out the link in the description for my top recommendation on expanding your knowledge on a personal scale. Meanwhile, as real estate firms continue to depend on bank financing, the risk extends to the country's lenders. In January 2024, Zhongji Enterprise Group, a Chinese shadow bank with significant exposure to the property sector, filed for bankruptcy. The group was in serious trouble with its debts, as reported by Beijing's First Intermediate People's Court, which had accepted the shadow bank's application for bankruptcy. Zhongji had been shaking since November 2023. In a letter to investors, the company laid out its financial woes. It owed somewhere between 420 billion to 460 billion yuan. That's about $59 billion to $65 billion, but its actual assets only amounted to $28.2 billion. That left them short by a whopping $36.4 billion. In October, Chinese authorities made a decisive call. They opted for bankruptcy as the best way to contain the impact of Zhongji's financial problems on the markets. A worsening of credit conditions could trigger a ripple effect, impacting the entire banking sector. China's authorities have been remarkably effective at tackling economic challenges during 4 decades of growth. However, addressing the current real estate crisis is proving to be a daunting task, even for them. The current crisis requires not just short-term fixes, but a comprehensive strategy to stabilize the market and restore confidence. Before you run off, don't forget to like the video and subscribe to the channel. If you're interested in exploring different economic landscapes around the world, be sure to check out the video on the screen.